In today's video, we're going to be talking about one of the most overlooked but important parts of retirement planning, and that's taxes. Many people assume that when they retire, their taxes will automatically go down. And for some retirees, this isn't the case. For some, there are surprises with their taxes, and those surprises can quietly eat away at your income if you're not prepared. Today, we're going to cover some of the biggest tax surprises in retirement, why they happen, and how you can properly plan so that they become in your control. One of the biggest misconceptions is that people think that retirement automatically equals a lower tax bill. And while your paycheck may stop, your income doesn't necessarily disappear. Between Social Security, pensions, required minimum distributions, and investment income, some retirees may find themselves in higher tax brackets than they would have expected. The shift from earning income to withdrawing income changes how and when taxes show up. Another common surprise for retirees is that Social Security can be taxable. Depending on your total income, up to 85% of Social Security can be subject to federal income tax. Withdrawals from IRAs, 401ks, and even investment income can contribute to your taxable Social Security income. This is why Social Security isn't just about when you file. It's how it fits into your overall income strategy. Another surprise that retirees run into is required minimum distributions, or RMDs. Once you reach a certain age, the IRS requires that you take money out of pre-tax accounts, whether you need the income or not. These required minimum distributions increase your taxable income directly. This can result in pushing you in a higher tax bracket, increase your tax on Social Security, and increase your Medicare premiums. For many retirees, RMDs become unexpected and one of the largest tax bills that they receive. Another surprise that retirees run into is the fact that Medicare premiums can go up due to your income. Medicare premiums aren't the same for everyone due to the fact that they're based on income. Higher income retirees may pay more to Medicare premiums through what's called income-related monthly adjustment amount, or IRMA. Large withdrawals, Roth conversions, and one-time income events can cause premiums to jump, sometimes years later, because Medicare takes a look back at prior year's income. This is a tax surprise that often shows up after the decision has already been made. Another surprise that retirees can run into is the fact that investment income is still taxed like normal. Capital gains, dividends, interest, these can all increase your tax bill, especially when these are combined with retirement withdrawals. This is where a withdrawal strategy and tax location become critical. If you'd like to learn more about tax location, be sure to visit the link in my bio where I covered a video in depth on this topic. It's not just about what you invest in, it's about where that money lives and how it's accessed. Overall, the common theme between all of these tax surprises is a lack of coordination. Retirement taxes aren't caused by one bad decision. They usually come from several reasonable decisions that just didn't come together properly. When withdrawals, Social Security, taxes, and healthcare are all coordinated, you can often reduce your surprises and keep more of your income. Taxes don't stop in retirement, they just change. And the earlier you understand those changes, the more control that you will have. This is control of your income, your lifestyle, and most importantly, your peace of mind. If you like videos like this and would like to continue learning more, please consider liking and subscribing. Thank you for watching and take care.